Good morning and welcome to another financial analysis video. Today I'm going to focus on Kinder Morgan and their dividend. I actually, based on the analysis I'm about to provide, sold my holdings of Kinder Morgan. I actually held them through the, I bought for a short period of time in the dip in August and did it for the dividend. Well, now I've come back and done some analysis over this dividend yield, and what I've found, what I'm going to show you, has caused me to turn around and sell my position in Kinder Morgan. So Kinder Morgan's dividend yield, which had historically been, a little above 4%, has recently climbed to 6 2/3%. It's a combination of an actual increased dividend by the board, but also by the stock's lowering price. It's pretty much dropped, a good 30 to 40% since spring. So that increased the dividend yield. Well, what I'm looking to see is whether or not this yield could be paid out by free cash flow or by earnings. And I'm going to show you a couple of methods that I use to find that. Cash flow is pretty easy. If we look here, I take operating cash flow less capital expenditures to get free cash flow. Well, the quarterly free cash flow here is very erratic, so let's go to a trailing 12-month number. So on a trailing 12-month basis, we're at $741 million of free cash flow for Kinder Morgan. So what I want to see is a quarterly dividend payout of under $200 million and a trailing 12-month payout of under $741. I'll go to my dividend tab here, which I take the dividend, I multiply it by the share count, and come up with an estimated dividend payment. Well, in this last quarter alone, the dividend payout was $1.07 billion. And since the company has undergone a number of changes, instead of doing trailing 12-month, I'm going to multiply that by 4 and just make the assumption that we're looking at a 4.2, possibly a $4.3 billion annual dividend payment. So the dividends are much larger than the free cash flow. So that does have me concerned that the company may not be able to sustain this level of dividend. Let's take a look at one other thing, and this would be along the lines of return on equity and how I calculate that. So I'm going to look at price to book value. For Kinder Morgan, it's around 1.8. Basically what this says is the stock is trading at 80% higher than book value. Now, this kind of gives me an idea of how much equity is needed to be generated in order to pay the dividend. So what I'm going to do is I'm going to take that 1.8 and I'm going to multiply it by the dividend yield. And what I get is a number that is almost right on 12%. So what we need is a 12% return on equity in order to pay for this dividend, because the dividend yield is 6.6% of market cap, not of book value. So I have to make that adjustment to show how much equity must be earned in order to pay for that. Well, if we look, we see again we're not close really in that department. Return on equity at best has been near 6%, and this is a 12-month calculation. So really, an ideal dividend yield for Kinder Morgan is probably somewhere around, and some of this too is because of the share growth they went through a couple quarters ago. So I would say it's more ideal that their dividend yield right now be closer to 2% than 6.6%. And so there's just too many warning signs here for me, and I'm going to have to back out of this stock, and I'm doing so Monday morning. So I think it's wise to do this. I'll hold the cash. I'll look for something else. And this is an analysis I'm going to do in the future prior to purchasing stocks for dividends. I hope everybody has a great day and happy investing.